Welcome to the final lesson of Module 3, Invoicing, Systems, and Routines. You know your numbers. Now let's make sure you get paid correctly and stay organized. This is the machinery that keeps a creative business running smoothly. Let's begin. Let's start with the invoice itself. A compliant invoice has 4 essential parts. First, the details of both parties, your name and address, the clients, and VAT numbers where they apply. Second, the line items. For each thing you're charging, a clear description, the quantity, the unit price, and the total. Third, the VAT breakdown, the rate you applied, and the exact tax amount charged. And fourth, legal numbering. Your invoices must follow a continuous, unique sequence, no gaps, no duplicates. This isn't bureaucracy for its own sake. A compliant invoice is what makes your payment enforceable and your taxes clean. Now, VAT. This is where the rules genuinely vary by country, so let's compare 3. In Portugal, the standard rate is 23%. Certified invoicing software is mandatory, and you must keep records for 10 years. In Estonia, the standard rate is 24%, slightly higher. But there's no certified software mandate, and records are kept for 7 years. In Bulgaria, the standard rate is 20%, and the country follows the EU e-invoicing standard, EN 16931. The lesson here is bigger than the numbers. Rules differ by country, so always verify your own country's rate, threshold, and obligations. Never simply copy another country's figures, as the difference between 7 and 10 years of record keeping shows. A few billing mistakes come up again and again. Let's make sure you avoid them. The first, missing VAT information. Without a VAT number or the correct rate, an invoice is non-compliant and hard to reclaim tax on. The second, broken numbering. Your invoices must run in a continuous, unique sequence. Gaps and duplicates raise red flags with tax authorities. The third, using non-certified tools where they are required. In Portugal, for instance, invoices must come from state-certified software an ordinary document editor simply won't do. When in doubt, use dedicated invoicing software. It quietly enforces most of these rules for you, so you can focus on the work. You don't have to track all of this by hand. Good tools do the heavy lifting. Many are free to start. Wave is free forever. In Estonia, Merit Activa and the state's own e-financials both offer free tiers. The best tools are VAT-ready programs like Simple Books and Smart Accounts can file your VAT returns straight to the authority. And keep one eye on the future. Electronic invoicing is spreading across the EU under the EN 16931 standard. So pick a tool that already supports it. My advice: start with a free tool that fits your country and upgrade only once the business grows into needing more. Finally, the habit that ties everything together: financial routines. 3 of them. First, a monthly reconciliation. Once a month, check that your bank statement matches your tracker. It's a simple question: does my spreadsheet match my bank account? It catches duplicates, missing entries, and quiet mistakes. Second, a quarterly review. Every 3 months, compare your actual income and costs against your plan. Did you earn what you expected? Did new costs appear? Third, adjust your pricing. Ask whether your rate still makes sense. Raise your packages if costs have risen. Drop services that aren't profitable. The trick is to write the routine down. On the 1st of every month, I reconcile my bank with my tracker. A routine you've committed to beats willpower every single time. Before the country details, let's cover the VAT basics, 3 ideas that carry most of the weight. First, the registration threshold. Below a certain yearly turnover, you may not need to charge VAT at all. Above it, registration becomes mandatory. That threshold varies a lot, around 40,000 euros in Estonia, and different again in Portugal and Bulgaria. Second, regular returns. Once you're registered, you file VAT returns on a schedule, often monthly, through your national tax portal. Third, cross-border rules. Selling across the EU follows the one-stop shop scheme, which lets you handle EU VAT in one place. Just keep the paperwork clean. The pattern is always the same. The concepts are shared across Europe, the numbers are local. So learn the idea here, then check your own country's figures. One structural question comes up again and again. Should you trade as a sole trader or set up a company? A sole trader trades under their own name. It's the simplest to set up, with no share capital required. But there's a catch: unlimited personal liability. Your personal assets are exposed, and you're taxed as personal income. It suits small, low-risk, occasional work. A limited company is a separate legal entity. Its big advantage is limited liability. Your personal assets are protected if the business runs into trouble. And often, only the profit you take out is taxed, while reinvested profit stays untaxed. In Estonia, for example, the private limited company, the OU umlaut, needs just 1 cent of share capital per shareholder, and only taxes distributed profit. That combination is exactly why it's become the standard, default choice for most creative freelancers. 2 compliance rules trip up creatives more than any others. Let's make sure they never trip you. The first is legal numbering. Your invoices must run in a unique, unbroken sequence, no gaps, and no reused numbers. Tax authorities watch for this, because broken numbering is a classic sign of missing income. The second is certified software. In some countries, Portugal is the clearest example. Invoices must come from state-certified invoicing tools. Where that rule applies, an ordinary document editor simply isn't compliant, even if the invoice looks perfect. And keep your records for the required time. It's 7 years in Estonia, 10 in Portugal, so always check your own country's rule. Get numbering and software right, and the rest of invoicing is genuinely straightforward. One more thing to keep on your radar: electronic invoicing. Across the EU, invoicing is going digital and machine-readable, and it's worth understanding before it reaches you. It's built on a shared EU standard, EN 16931, which makes invoices readable by software across borders. The rollout is happening in stages. Business-to-government e-invoicing is already mandatory in many places, and broader business-to-business e-invoicing is expected around 2027, with some countries, like Estonia, already moving. So here's the practical takeaway: you don't need to act today. But when you choose your invoicing tool, pick one that already supports structured e-invoices. That small choice now means no scramble when the rules arrive. Let's bring Module 3 together in 4 steps. Lesson 1, Creative Finance. You learn to see your money with separate accounts, a simple tracker, and a money map. And that profit is not the same as cash. Lesson 2, Budgeting and Cash Flow. You learn to plan ahead, track cash flow, and calculate your runway, your survival number. Lesson 3, Pricing and Break-Even. You learned your costs and break-even point, how to set a sustainable rate, and how to price by value. And Lesson 4, Invoicing and Routines. Compliant invoices, VAT rules that vary by country, and the monthly and quarterly habits that keep it all running. That completes Module 3. You now have a complete, practical system for managing creative finances. Money you can see, a plan you can trust, prices that work, and routines that hold. This project is funded by the European Union. Thank you for watching.